Welcome to the Goose Hollow Capital Weekly Market Update. In this edition, we recap recent events, preview what's on the horizon, and share some interesting charts that caught our attention.
Welcome back for the deep dive this week. All right, welcome back, everybody. Ready for another deep dive?
Definitely always ready to dig into the data.
This one's going to be especially interesting for those of you, trying to figure out what this GOP sweep really means for your portfolio. We got some great research here. Really dives into potential policy changes, and their potential impact.
Yeah.
And I got to say, just glancing through it, I was struck by, I guess, a couple things right off the bat.
Okay.
On the one hand, the market's reaction kind of echoes what we saw in 2016 in some ways, but then in other ways, it's totally different, right? Like Bitcoin.
Yeah, that's a head scratcher.
And they, despite all the talk about diversifying supply chains,
right,
it seems like China is still kind of the 800-pound gorilla, even in like advanced tech.
Yeah, definitely a lot to unpack there.
So let's dive in, shall we?
Absolutely.
So I'm looking at these charts comparing, 2024 to 2016, and the first thing that jumps out is the S&P 500. It's up, right?
Right.
And it's a much stronger rally than we saw at this point in 2016.
Yeah, definitely a more bullish initial reaction this time around.
So what do you make of that? I mean, is there just like a different economic backdrop?
Well, I think it's probably a combination of factors, right? I mean, we've got a different economic backdrop, different global landscape, different expectations maybe about what this administration's policies are going to look like.
Okay, so you think some of that's already priced in?
I think the market's trying to figure that out, right? Like how much of this is just initial sentiment and how much is based on, real policy analysis.
Right.
And I think, when we look at some of the other asset classes, it kind of paints a bit of a mixed picture.
Okay, well, let's walk through those.
Yeah.
So U.S. equities, they're outperforming international. Small caps are outperforming large caps. I mean, that's pretty much in line with 2016, right?
Yeah, those trends are they're fairly consistent with what we saw back then. But then, we look at bond yields.
Right.
And the initial reaction was a spike. Then they dipped. And now, actually, they're lower than they were at this point in 2016.
Interesting.
And real yields are showing a similar kind of mixed picture.
So what's the takeaway there? What do you think that's telling us?
I think it's almost as if the market's trying to figure out the long game here, like what's the real impact of these potential policy changes going to be on growth, on inflation.
Yeah.
And I think there's still a lot of uncertainty around that.
Yeah, makes sense.
We've got break-even inflation's up.
Yeah, almost mirroring 2016, it looks like.
Yeah, pretty close.
But the dollar's telling a different story, right?
Right. It's stronger, but not as dramatically as it was after the 2016 election.
Interesting.
The Chinese yuan is down.
Which is consistent with the previous pattern.
Yeah, not down, just like 2016.
Okay, so those are the echoes.
Yeah, I mean, those currency and commodity moves, they're definitely worth watching closely, I think.
Why? Why is that?
Well, because they can signal shifts in global trade, right? They can influence inflation expectations.
Right, and that obviously has a direct impact on,
absolutely,
investment decisions.
For sure, yeah.
Now, one thing that is a bit different, I guess, is Chinese equities. They're down, but not nearly as much as in 2016.
Right, it's a much more muted reaction this time.
I wonder if that's a sign that some investors are more confident in China's resilience.
Yeah. It's possible, right?
Despite, potential trade tensions and all that.
Yeah, maybe they're seeing it as less vulnerable to U.S. policy changes, or maybe they're just more bullish on China's long-term prospects regardless.
Right.
But I think the bigger picture here is that China remains a dominant force in those global supply chains.
Right.
And that's something, investors really need to be aware of.
For sure.
I mean, the research you've got here shows that, they're the cheapest supplier across a surprisingly wide range of sectors.
Yeah, it's not just, footwear and metals anymore.
Right, exactly.
It's like advanced tech, data processing equipment.
Yeah.
Semiconductors. I mean,
it's pretty striking.
It is, and that's got to make it That's going to make it pretty tough for businesses that are trying to,
Oh, absolutely.
diversify their supply chains.
It adds a whole other layer of complexity, right?
For sure. I mean, it seems like, any attempts to really shift away from China
Yeah.
could lead to higher costs,
Right.
which then, could feed into inflation.
Exactly. It's a real dilemma, and it's going to be interesting to see how
Okay.
how this incoming administration tries to navigate that.
Yeah. How do you see them, approaching this whole trade landscape with China?
I mean, it's a tightrope walk, right?
Mm-hmm.
On the one hand, there's going to be a lot of pressure to reduce reliance on China,
Right.
to bring back manufacturing jobs.
Mm-hmm.
But on the other hand, if they slap on a bunch of tariffs,
Right.
that could lead to price hikes
Yeah.
that hurt consumers and businesses.
Right. So it's a delicate balance.
It is. It's a very delicate balance.
And that brings us to, this chart showing kind of how different sectors performed during the trade war back in 2018, 2019.
Right. Right.
What jumps out at me is that some sectors, like utilities, telecoms, consumer staples,
Mm-hmm.
they actually did, better than the S&P 500 during those periods of like tariff risk.
Yeah, and I think that's a really key takeaway for investors, right? Is it suggests that those sectors are probably more insulated from trade tensions.
Why is that?
Well, maybe because they're more domestically focused or less reliant on global supply chains. But, whatever the reason.
Right.
It seems like they were able to weather that storm a little bit better.
Okay, so on the flip side, what sectors got hit the hardest?
Well, semiconductors.
Makes sense.
And not surprisingly, China ADRs took a pretty big hit.
Right. So if we see, another round of trade conflicts,
Yeah,
potentially we could see kind of similar patterns play out.
it's definitely a possibility.
Okay. And then there's, I guess the elephant in the room, Bitcoin.
Right.
It's gone parabolic, right?
It has. It's on a tear unlike anything we saw in 2016.
Yeah. So what's driving that? I mean, is it a bet on, potential policy changes that are going to be, more favorable to crypto?
It could be.
Or is it a hedge against inflation?
Possibly.
Or is it something else entirely?
It's hard to say for sure. I
Yeah.
think it's a reminder that crypto is operating in a different world, right? It's got its own set of drivers.
Right.
And it's not always going to move in lockstep with the rest of the market.
Okay. So lots to unpack there.
Yeah.
We've got, echoes of 2016, but also some pretty stark divergences.
Mm-hmm.
And then, the potential for some new challenges with trade, with crypto. I mean,
Right.
What's clear is that things are shifting.
Yeah.
And investors need to pay attention.
Absolutely. This initial market reaction.
Right.
It's a mix of sentiment and policy expectations, but to really get a clearer picture, I think we need to dive into, the specific policy changes that are likely to emerge.
Yep.
And what they could mean for your investments.
All right. Well, let's do that then.
Sounds good. Okay, so let's shift gears a little bit and talk about immigration.
Okay.
This is an area where potential policy changes could have, major ripple effects
Right.
across multiple sectors.
Yeah. Makes sense.
And we know there have been, calls to restrict immigration.
Mm-hmm.
And, obviously that has implications for labor markets and
Right.
ultimately for your investment strategy.
Right. Okay. So we've got a couple charts here,
Yeah.
but I think tell an interesting story.
Okay.
One shows a decline in multifamily building permits,
Mm-hmm.
and the other highlights, the high percentage of immigrants in construction trades
Right.
that are already facing labor shortages.
Yeah.
So tighter immigration policies
Uh-huh.
could make those shortages even worse, right?
Exactly. I mean, that's the concern.
Hmm.
And then, if you have a shortage of labor,
Right.
that could push wages up,
Right.
which, feeds into inflation.
Right. And then that has a knock-on effect on the housing market.
Absolutely, especially rentals, right?
Yeah.
I mean, if you've got, higher construction costs,
Mm-hmm.
a tighter labor pool,
No.
that could mean less supply,
Right.
higher rents,
Okay. So
which, obviously impacts real estate investments,
so more pressure on housing costs
potentially.
at
Yeah.
a time when, affordability is already a major concern.
It's a real challenge.
It is. Okay. Speaking of potential economic landmines.
Okay.
Let's talk about private credit.
All right.
I'm really interested in this, this rise of private credit.
Yeah.
And kind of its interconnectedness with the broader financial system.
Absolutely. This is something that I think sophisticated investors really need to be paying attention to. The charts you've got here show a pretty rapid rise in private credit, right?
Yeah.
Coupled with increasing default rates. That's a red flag.
For sure.
And what's particularly concerning is the potential spillover risk to other institutions like insurance companies and pension funds.
Right.
They've been increasing their exposure to private credit. And if those bets start going south, it could, create a real domino effect.
Okay, and then there's also this this growing entanglement between banks and private credit funds.
Right.
You mentioned synthetic risk transfers earlier.
Yeah.
This sounds like a bit like financial alchemy to me.
It's pretty complicated stuff.
So what are the implications here for investors like us?
Well, think of it this way. Banks are partnering with these private credit funds to fund new deals. Yeah. Right. And then they're also offloading risk through these complex instruments to reduce their own, regulatory capital requirements. So it creates this web of interconnectedness that could, amplify any shocks to the system.
So private credit is basically a growing blind spot.
I think that's a fair assessment.
The financial system and the lack of transparency
makes it even harder to assess the risks, right?
Exactly. Okay, let's shift gears again.
Okay.
And talk about high yield spreads.
Right.
These are kind of flashing a warning signal right now. They're really close to historical lows.
Yeah, relative to treasuries.
Right. So what does that mean?
Well, it means investors are demanding very little extra yield for the risk of holding high yield bonds. But there's a potential catalyst here that could change that very quickly, and that's downgrades.
Downgrades. You're talking about companies like
like Boeing and Celanese.
Right, okay.
If they were to get downgraded to high yield, we could see a huge influx of, $70 billion in new high yield supply.
Wow.
Hitting the market.
Right.
That kind of supply surge, that could push spreads wider.
Right.
Make it more expensive for companies to borrow and potentially, ripple out to the broader economy.
So this is definitely a scenario to keep on the radar.
Absolutely.
Okay. Speaking of potential economic disruptions. Let's talk about the Fed.
Right.
There's speculation that this incoming administration might make some changes to the Fed structure, maybe even, curbing its independence.
Yeah, that's a big question mark right now.
It is, and this is where I think that chart from Allison and Summers becomes particularly relevant.
Yeah, I think this chart illustrates a really key point.
Okay.
It shows an inverse relationship between central bank independence.
Right. And inflation, historically, the more independent the central bank, the lower the average inflation rate.
So what are you saying? Are you saying we could see,
Well, it raises the question, right?
Right.
Could we see higher inflation? If the Fed's independence is eroded,
right?
And how might that impact, your investment decisions?
Yeah, these are big questions.
Big questions. Yeah.
Lots of uncertainty.
Yeah.
Swirling around the Fed's future, and that uncertainty, can create volatility.
Right.
Which nobody likes.
No investor likes volatility.
Okay. Speaking of long-term trends.
Okay.
This final chart you provided. Is a real eye-opener, I gotta say.
Interesting.
It shows the aging U.S. government.
Right.
Compared to other developed democracies. And, what's striking is that the average age of government officials in the U.S.
is steadily climbing, right?
It is, yeah.
While it's remained relatively stable in these other countries.
Yeah, it's a pretty stark contrast.
It is. So what do you make of that?
Well, I think this demographic shift has profound implications.
Okay.
Both politically and economically, right? I mean, how might this influence policy decisions?
Right.
What are the long-term consequences for economic growth?
Right.
For social programs?
Right.
These are questions that I think deserve careful consideration, especially for long-term investors.
Okay, that's a good point. Okay, so wow, we've covered a lot of ground here.
We have.
And it's pretty clear that the investment landscape is shifting in response to this election.
For sure.
So let's try to kind of distill some key takeaways
Okay.
for you as we wrap up this deep dive.
Sounds good.
What are the big things that investors should be thinking about right now?
Well, I think, first of all, we saw that the market's initial reaction to the GOP sweep,
Right.
it has some parallels to 2016,
Hmm.
but also some important differences.
Right, like we talked about with Bitcoin.
Exactly. And the relative strength of the S&P rally.
Mhm.
So I think that underscores the importance of looking beyond, just broad market indices and really digging into, sector-specific trends
Right.
and potential risks.
Okay, so sector-specific analysis is key.
I think so, yeah.
What else? What else should we be keeping in mind?
Well, the fact that, China remains such a dominant force
Right.
in global supply chains,
Hmm. Even in advanced tech.
even in advanced tech, I mean, that's a key takeaway here.
Yeah, it's pretty mind-blowing.
It is, and it raises questions about, the feasibility of diversification
Right.
and the potential cost.
Right, because any disruption to those supply chains could have,
Huge ripple effects.
yeah, on costs, on inflation.
Absolutely.
So we got to factor that in.
You do, yeah. As an investor, you need to be thinking about,
Right.
okay, what are my exposures?
Hmm.
How vulnerable am I to these potential disruptions?
Right. And then we also talked about, some potential policy shifts
Yeah,
that could, either create headwinds or tailwinds for certain sectors.
right, exactly.
Trade tensions, immigration restrictions, potential changes to the Fed's independence.
Mm-hmm.
I mean, these are all things that could really,
Yeah.
impact market volatility and the overall economic outlook.
They're uncertain times,
They are.
but they also present, opportunities
Okay.
for those who are prepared and willing to think critically.
That's a good point. Well said. Well, as always, thank you for joining us on this deep dive.
My pleasure.
We hope you found this, analysis insightful and valuable
Yeah,
as you navigate the complexities of the market.
absolutely.
Remember, informed investors are empowered investors.
Oh, that's right.
So until next time, keep learning,
Keep learning.
keep questioning,
Keep questioning.
and keep investing wisely.
Wisely, yeah.
This material is intended for information purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities to any person in any jurisdiction. The opinions expressed are subject to change without notice. This information is not intended to be complete or exhaustive, and no representations or warranties, either express or implied, are made regarding the accuracy or completeness of the information contained herein. This material may contain estimates and forward-looking statements, which may include forecasts and do not represent a guarantee of future performance.